Have you ever struggled with finding the exact trend of the market? Well, there are many indicators and methods used to determine trends such as a moving average, but one uncommon, yet surprisingly good way to determine this is with the Ichimoku indicator. However, we at Switch Stats understand that this indicator can be quite intimidating, causing traders to usually shy away from using it. But in today's video, we will go over exactly how the Ichimoku indicator works, in an easy-to-understand format, and we will also be sharing a secret version of this indicator that has a strategy that not many know about. By the end of this video, you will have a complete grasp on the indicator and its functions. Let's go to Trading View and right-click to clear your chart. Now click the Indicators tab and search Ichimoku Cloud. Click on this one under Technicals. This is the Ichimoku indicator. All these lines, even though it looks confusing, has an important function. Let's start with the most obvious aspect, which is the cloud. The cloud is there to show momentum in the market. It is made up of the span A line and span B line. If the cloud is red, the long-term momentum is bearish, and when green, the momentum is bullish. Next, the blue and red lines under the cloud are for determining trend. You can think of them as moving averages. The blue line, called the conversion line, is a 9-period, and the red line, called the baseline, is a 26-period. These lines are calculated slightly different, so if you were to add regular moving averages to the chart with the same periods, you will notice they are slightly offset. When these lines cross in alignment with the cloud, this is typically a signal to buy or sell. And finally, we have this green line, which is called the lagging span. This line is just the current price plotted and offset in the past. The way you are supposed to use this line is that if the line is far away from price, the trend is considered strong, but if it is close to price, the trend is weak. To keep things simple, we will disable the lagging span line, given that we already have two other lines to determine trend direction. Now this is how this indicator is supposed to be used. Here we can see that the cloud is red, so we only want to look for sell positions. We need to now wait for the baseline to cross above the conversion line to indicate a bearish trend. Next, we can execute a position keeping stop above the recent swing high and target a 1-to-2 risk-to-reward ratio. For long trades, we want to wait for the cloud to be green, indicating bullish momentum. Then we want the baseline to cross below the conversion line for a buy signal. Now we execute with stops below the recent swing low and target a 1-to-2 risk-to-reward ratio. When executing trades, it is important to make sure that the candles are not in the cloud. If the candles are inside the cloud, this usually indicates that the market is ranging and you should wait for a more clear market structure before taking trades. Another important thing to note is that the lines on the cloud can be used as support and resistance. When the lines are flat, this can be an indication of a strong support or resistance zone. So when price approaches these levels, if the lines remain flat, you could see a strong reaction off these levels. If the cloud is green and price goes below the cloud and the line is holding strong, it could operate as a rejection zone. Same with a bearish cloud. If the price goes above a bearish cloud and the line holds strong, price could reject off that line. While this indicator is a great indicator, it was created in 1930, and since then there has been attempts to recreate this indicator using a modern approach to further expand on its already useful functions. One of those new developments has been able to allow for better trend and momentum detection, which in turn leads to better trade executions, as shown here and here. If you are enjoying the video, don't forget to like and subscribe to not miss out on future videos. You can also use the link in the video description to test the top indicator suite on TradingView, LuxAlgo Premium, risk-free for 30 days. Your support really helps the channel. Now let's add the new indicator to our chart. Let's click on the Indicators tab and search Super Ichi, this one by LuxAlgo. As mentioned, this version of the indicator will allow us to get better zones, entries, and as you can see, it is far cleaner than the older version. If we go into the settings, we can see that the lagging line on this indicator is called the Chikou line and it is off by default. For this strategy, we will have this line enabled since it is much easier to understand here. You might have also noticed that the trend lines on this indicator also tend to stay close to each other, unlike the older version. This is because the developers have also used the super trend indicator as a basis for the calculations here. For our strategy, we will use the Ichimoku line to filter trades, and use the cloud and the two other lines to determine the trend. Here is an example of a trade. We are currently on EUR/USD 1-hour timeframe. Just as before, we want to use the color of the cloud to determine the direction we will be trading. If the cloud is red, we want to seek sells, and if the cloud is green, we want to seek buys. We also want to ensure that price is not closing inside the cloud, as just as before this would indicate a consolidation. Next, we want to ensure that the two inner trend lines are also in the direction of the trend. So unlike before where we used these lines for entries, in this case we are using them as confluence for the setup. If the cloud is green, the blue line should be maintaining above the orange line, which is a bullish trend, and if the cloud is red, the orange line should remain above the blue line. You can also use these orange and blue dots to confirm when a cross has occurred. Next, we want to ensure that the Ichimoku line is not too close to price, as if it is too close to price, this indicates that the market could begin to range soon. Once we have confirmed these rules, we can take an entry. Here we have a bullish cloud, and we have a blue dot to confirm the trend, and the Ichimoku line is not close to the price. We now want to wait for price to pull back below the trend lines. Once this happens and we see signs of bullish reaction, we will execute a buy trade, set stops at recent swing low, and target a 1 to 2 risk to reward. Here is another example. Price is bullish and has retraced below the trend lines, while our conditions are still met. The cloud is bullish, and the Ichimoku line is not too close to price, and the blue trend line is maintaining above the orange line. We wait for a reaction and execute a buy and keep stops below the recent swing low. For sell positions, we do the opposite. Here the cloud is bearish, and the orange trend line is maintaining above the blue line. Price has pulled back above the trend lines and is rejecting, so we will execute a sell with stops above recent swing highs and target a 1 to 2 risk to reward ratio. This new and updated version of the Ichimoku indicator makes it easier to understand the current market sentiment, whereas the older version of the indicator was very confusing, and that confusion can sometimes cause trading paralysis, causing you to miss out on extremely profitable trades. This version is far cleaner and is much faster at detecting trend changes and holding trends longer, as it is also based on the super trend indicator. We hope you enjoyed this video on the Ichimoku indicators. Don't forget you can use the link in the video description to try Lux Algo Premium for 30 days risk-free, where you will get access to the signals and overlays indicator, the oscillator matrix, and the price action concepts indicator, all developed by the top developers on the platform. Don't forget to like and subscribe, and we will see you again in the next video.